Hello, ladies and gentlemen. How do you do? I'm Seth Julian, your host for this the week that was. We're going to take a look at what's in this week so we can prepare ourselves for the upcoming trading. And it is a great deal of activity. For those of you who are unaware, and that is, I assume, none of you, the war in the Ukraine has affected virtually every single solitary market we look at. The trading opportunities have been tremendous. And so we're going to take a look at some of them right now. This one, of course, as you all well know, is natural gas. Just a few hours ago, the United States President and the President of the European Council, Mrs. van der Leyen, announced a plan to ship 15 billion cubic meters, billion or million? Excuse me, 15 billion, yes, cubic meters of natural gas via LNG to Europe. Now that's a piddling because they buy 150 billion a year, 155 billion a year from the Russians. So it's about 10%, but it's a start. And this is what we want to keep our eye on. The price of this gas is going up, regardless of who's shipping what to whom. All of the Russian output is coming off the market. Well, except if you're Chinese, of course. It's all going to go to Asia and mostly to China. And for those of you who pay attention to our reports on a regular basis, we've maintained for some time now that one of the major objectives of this effort in the Ukraine is to not only bring the Ukrainians to heel, which will surely fail, but to redirect the flow of Russian hydrocarbons from Europe to China. And that's going to happen. Why, God only knows, but that's what's going to happen. And the Chinese, of course, will be buying it at a deep discount, but we won't go into that at the moment. Suffice to say, natural gas up. Of course, this trade, which we bought in at the high point, will come back. This is palladium. Palladium is a crucial element in the input of automobiles. It goes into catalytic converters. And Russia produces 70% of the world's palladium. Get the idea? So this anomaly, it peaked there, the mark, and this, you'll see this pattern repeatedly. We'll show you this pattern in a couple of assets where it spikes up, comes down. This is WTI, this is Brent, and you can see it spikes up and comes down, but it's going to continue up. And that's true in Brent, that's true in West Texas, that's true, you see this pattern a fair amount. So you get and of course, the grains. We didn't even talk about the grains. Rice, corn, wheat, wheat, corn, oats, barley, canola, rapeseed oil. All of those things are going through the roof because, just to cite, Russia is the world's largest exporter of wheat. The Ukraine is the third largest exporter of wheat. Those crops are off the mark now, and the Ukraine surely won't even be planting for the spring harvest, and nobody's blaming Russia except the Chinese. So all of their production goes off thereby driving prices up. And there is one more feature of the grain, the field grains, field crops that I want to emphasize, and that is that Russia is the number 6 producer in the world of potassium, a major into fertilizer. So if fertilizer prices rise, not only will the cost of the grain rise, but the yields are likely to come down as farmers use slightly less or consider less in their field, bringing down the yield. Again, decreasing supply, raising price to meet the demand. Oh yes, and if that weren't enough, bread obviously is going to go through the roof very shortly. Right now, these are just prices that flash on our screens, but shortly, very shortly, these are going to come through to the real economy. And in places like Egypt, where a huge majority of the population subsists on subsidized bread, the government is going to either have to pay higher prices or reduce the subsidies, causing political unrest. So you can believe that political unrest will be caused by the rise in wheat prices. Just keep your eyes focused on the Middle East, that imports something like 80% of its grain needs. So this is what's happening on the commodities markets. That's where a major effect is being felt. But there are other things going on this week, and I want you to be aware of them as well. Interest rates are rising. We suffer from an inflation induced by the pandemic. And as you're probably aware, the pandemic caused huge supply imbalances in the supply lines of the world. For the first time in economic history, governments mandated that their workforces stay at home. Normally, in the face of economic distress, governments encourage their workforce to go to work despite the risks and the dangers to keep the economy ticking over. Well, not this time. So that almost within days of the pandemic hitting the West, and we mark that as pretty much March 20 at the end of Q1 2020, all industrial production virtually grinds to a halt. But within a fairly short time, a quarter of a year, by the end of June, demand skyrockets. The 35% of the population that's staying home and working now has to upgrade their home systems. They want to make their homes cozier. The governments are pumping tremendous cash into their bank accounts, so they've got money to spend. Demand skyrockets for everything from microphones to cameras to keyboards to office equipment to just home furnishings to make their homes cozier. Well, the supply lines weren't ready for this. There were containers empty where they needed to go to be filled. There was freight waiting to be shipped where there were no containers to put them into to ship. Factories that had been shut were now couldn't really yet open to meet that demand. Well, you get the idea. That's what a supply line glitch is all about. Any of you who ever been subject to supply lines understand that. And now we're all big supply line logistics experts. So the price thing went up. And what we heard from central bankers particularly was this annoying thing of transitory. I don't know what was wrong with the word temporary, but somehow central bankers love jargon. And so they decided that transitory was the word than temporary. So their thinking was, well, just let the inflation run. We don't want to inhibit any economic recovery that's underway. We want to get the labor force back at work. They let the inflation rise. They let the inflation, as they say, the economy run. With the idea that once the supply lines balanced out, inflation would largely vaporize. I, by the way, subscribe to that. Despite the idiotic use of the word transitory, I pretty much bought into that. Supply lines would open up and straighten out soon. But we didn't bank on the Ukrainian war and open warfare once again. As a child, I'm 64 years old. As a child of the Cold War, I'm just shocked, as we all are, to believe that there's open warfare yet again in Europe. And I have to tell you, I went back to a book that I hadn't read in 45 years, entitled, ominously enough, On Thermonuclear War by a guy named Herman Kahn. Kahn was a genius, and I'll tell you what, one of the reasons he's a genius is because that book is right till today. It's heavy reading. It's not for everybody. But if you really want to understand nuclear deterrence, nuclear escalation, read the book. It's completely applicable today. It's a course of escalation, and Putin is following the script exactly as Kahn predicted. He as the Soviets did, as the Americans did. It's the Bible of nuclear warfare, or pre-nuclear warfare, I should say. So, not having banked this, inflation is going to go through the roof. We haven't even seen inflation. It's going to go well into the double digits. We'll probably reach 2% by the end of next year or two. And as a result of that, bond prices fall. As bond prices fall, so these have been great trades, selling off bonds. Nobody wants them. Fixed coupon rate, interest rate return. So the bond prices are falling as interest rates rise. Of course, let's take a look at our friends, the currencies. The currencies also, actually, I want to show you one before we go to currencies per se. I want to show you the dollar index, because this really explains most of the currency developments. And that is the dollar index. Look at this. The dollar index is from here to here, from 89 to 98. That's a slightly more. Here, I'll do the math right now for you. It went from 89 to 98. That is a 10.11% jump. Now, as you know, those of you who trade FX, and that's most of us, these currencies move in, thousands of percent. They trade pips after all. Pips are 4 places right of the decimal point. This is 10 solid percent. That's like 1,000, like 100,000 pips. It's a huge amount. And that strength in the dollar has the fact that if the shit hits the fan, you'll play French. We run to safe havens, safe ports in a storm, and that's pretty much only the U.S. dollar. We're going to run to the euro. The euro is under attack. Europe is under attack. The United States is fortressing Europe. What are you going to buy? The yuan? And I'll tell you something else. What's more interesting from that point of view is when we look at currency, what had been, for some reason I never grasped, considered a safe haven currency ain't. This is the yen against the Kiwi. This is the yen against the Aussie. This is the yen against the euro. The yen against the sterling. The yen has been universally weak, and these are great trades. The yen is weakening considerably, and it's all across the board. Now, why that is, I can't say, because I can't say the reason why the yen had previously been considered a safe haven. I never knew the yen to be safe. The Japanese economy is weak. It's been stagnated for most of our lives, for 30 years now. And I don't know why people would buy the yen as a cover for safety, but just because I don't understand it doesn't mean anything. But I can't explain. I can certainly explain why it's weakening. Yen, the Japanese economy is virtually entirely dependent on imported resources. Other than rice, I don't believe it's self-sufficient in any resource, any commodity resource. They need to import everything. Well, there you go. I think that explains most of this. So the yen weakness trade has been fantastic. We'll take a look at some other currencies that are really... These are all, by the way, daily charts. Again, these outstanding ones. This is the Swiss yen. This is the CAD yen. And the currencies that are strengthening, besides the U.S. dollar yen, of course, are the oil exporters. Canada. Where's Mexico? This is the dollar. The Mexican would be in developing. But the Norwegian kroner. Big oil exporters. Let's just take a look at some of the emerging markets, currencies. You'll see the Mexico immediately. Here's the South African rand getting stronger on the back of resources, palladium, gold. South Africa is a hugely rich resource economy, and so their money is running into their currency in order to procure those assets. Hong Kong dollar obviously weakening. The Turkish lira, which we made a great deal of money out of during this long and absolutely transparent run-up, is continuing its run-up. You can always count on Sultan Erdogan to do the wrong thing with respect to monetary policy. So that's been a great trade for a long time. The ruble, I just want to point this out so you understand. The ruble made a huge run-up. It's come down a little bit. That's because there's no trade in it. You can't trade the ruble by us or any other brokerage on the face of the earth. It's currency non grata. Nobody trades it. It's become off limits. So what happens to the price is interesting but irrelevant. Oh, here's the max. Look at that. The peso has strengthened wildly against the U.S. dollar, and that's in the face of strong U.S. dollar price, strong U.S. dollar. It's still the oil exporting countries are going to have very powerful currencies. Brazil, a commodities giant, the largest producer of soy on earth. I believe they're also the largest producer of wheat, but it's either Brazil or the United States. I said that Russia is the largest exporter of wheat, but they're also the largest producer of orange juice, coffee, you name it. These guys, did I mention copper and tin and zinc, all sorts of stuff. Iron ore, I believe also. So the Brazilian real, va-va-va-voom. So our currencies are doing great trades these days. And normally I trade currencies like everybody else now and then because they're interesting and they're fun, but not because they're so hugely volatile. Well, that's not true. They're hugely volatile. And there's a lot of money to be made. The last thing I want to take a look at today in our summary is the indices. And here we have what I would consider an anomaly, except for the Tadawul, which is here. Tadawul, of course, is va-va-va-voom. It's a site. It's been a great trade. I highly recommend you own it. And largely due to the fact that over 20.44% of the Tadawul is accounted for by Saudi Aramco, the world's largest oil producer and refiner. And not refiner, I'm sorry, producer. And so as Aramco goes, as oil goes, Aramco goes. As Aramco goes, so goes the Tadawul. But barring that outlier, you have seen the tail ends of these indices. This is the NASDAQ. This is the, you can't really see them so well because of the light in my office today, but this is the Milan, the Nikkei. That's the dollar index. That's not a stock index. This is the Amsterdam. You'll notice they're all pretty much tracing the same pattern. They've taken a rebound. This is the fall off that we all saw as inflation started to kick in and bond prices started to rise and interest rates started to rise. The Federal Reserve made that clear last week. And now they've all taken this sort of rebound. Don't believe it. It's a dead cat bounce, as they like to say. As it's falling, it bounced up. It's going to fall. It's going to fall strongly. I don't recommend taking stock positions. I recommend liquidating these stock positions and moving into commodities and moving into and selling short bonds. There is just one category I do want to touch on before we end up for today, and that's our newest member of the capital market family, the cryptos. And if we take a look at my personal favorite, which is Ether Dollar, which I recommend to anybody who's willing to listen and have for some time, not as a trading currency, it's way, way, way too volatile, but as a long-term asset, I believe this has huge potential. They're stabilizing. These are all daily charts, I believe. Oh, that's a weekly. My mistake. Let's go to the daily. They're in a trading range. They're stabilizing. They fell off too, as everything sort of fell off following the rise in inflation and then the resultant rise in interest rates. But as the let me find Bitcoin dollar, his Bitcoin dollar, of course. And let's make sure. Yeah, this is the daily. They're stabilizing. I believe that's a very good sign. And if you're holding for the long run, continue to hold. Add to your positions in the cryptos. I believe they're going to go up, but these are not trading assets because you have to have a stomach lined with lead to be able to withstand the tremendous volatility. So, ladies and gentlemen, we're going to end today's session on this note. And that is that the world is changing under our very feet. Europe is at war. The world order of globalized, rules-based trade is being shaken to its core. The Chinese are likely to be major beneficiaries. It's going to cost Europe in cash and blood and treasure a great deal before this irons out. The Americans are obviously, obviously, after yesterday's announcements and meetings, the G7 and NATO and the European Council with the U.S. President, are going to fortify the Atlantic Alliance. But no mistake, the good times are done rolling for a while. We're going to have to hunker down. We're going to have to sell things short. We're going to have to be defensive. The tech giants and all of their monopoly. Oh, yes, speaking about tech giants and monopoly, let me just say that one of the things that was announced, sort of by the way, when President Biden and Mrs. van der Leyen spoke about cooperation, was a veiled yet obvious threat to the tech monopolists. Their monopoly profits and monopoly rents are going to come to an end. They use the code freedom of privacy, data protection. These are all code words for reining in the tech giants that make a huge profit out of selling information about us without our permission, oftentimes, and certainly without our ability to share in those profits. So those good times are going to be coming to an end as well. Excuse me. So, ladies and gentlemen, with that, I'm going to bring the weekly review to a close and wish you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.